part of our conversation today, which is, so how do you pay yourself as a business owner to ensure that you're not commingling funds, and the money that you're taking out, you can spend it on yourself, and also understand how it's going to get taxed, so you're wise about the way you go paying yourself. All right. So when it comes to paying yourself as a business owner, it's very important that we understand what your business entity structure is. All right. So when it comes to business entity structure, there are four main structures that we look at from this perspective, or from this tax perspective. Okay. You can either be a sole proprietor, or I can even call you an independent contractor, someone who works for himself. A sole proprietor is someone who doesn't even necessarily have a business registered per se. You're treated the same way as an independent contractor who doesn't have a business either as well, who gets paid on the 1099. And you also are treated as a single member LLC who has not made any elections to be treated as an S corp or C corp for taxes. Okay, so we're going to group these three people into one category, and these are the people that file their taxes on a Schedule C. Okay, now let's start with the sole proprietor, this category. Oh, that's the first category. Let me list all them and then I'll come to each one. All right, the second category we're going to talk about is partnerships. So partnerships, whether I talked about different entities last week. So whether it's a partnership where you met, shook hands with someone, and you went into this business, and we call you a general partnership, you're not registered, but you're in business. Or you're a multi-member LLC, where you actually registered your LLC. So long as you've also not made an election to be treated as an S corp or C corp, you are a partnership. So the LLC, if the LLC has not made any election, and with two or more members, is treated as a partnership. All right. So we have our first group, sole proprietor, single member LLC, or independent contractor. One. Second group, partnerships. Third group, S corporation. And the S corp is someone who has made an election and told the IRS, I want you to treat me as an S corp for tax purposes, as a separate entity from my business for tax purposes. Okay. And the S corp is not an entity you register; it's an election you make with the IRS. And then the fourth group is the C corporation. All right, this is an entity that is completely separate from the individual, and functions on its own, has a board of directors that makes decisions and all that 9 yards. So these are the four entities we're going to be looking at when we talk about how you should pay yourself as a business owner. All right, so that way you can follow this conversation knowing based on how your business is currently set up, knowing how you will pay yourself. All right, so the first entity structure is the first group is the business owners that file on a Schedule C. So these are the sole proprietors, the people that didn't necessarily register a business, but they're doing the business. They're still making money and they're incurring expenses. This is the independent contractor that works for himself or herself, incurs expenses, to be able to do the work that they generate revenue for, or the single member LLC. All right. These three groups of people report their income and expenses on what we call a Schedule C. And this Schedule C is a part of your personal taxes. So when you file your personal taxes, your Schedule C is a part of it. That's why even if you're a single member LLC, if I call the IRS to talk about your business, I don't give them your EIN. I give them your social security number, because you're reporting your business income and expenses on a Schedule C that is part of your personal taxes. So for that reason, the IRS calls you disregarded. Okay? Disregarded just means, it's not a bad thing, but it just means that we are not treating your business as separate from you. You and your business in this context is one. So then how do you pay yourself? All right. It's important that you know that when you make a profit on as this single member LLC or sole proprietor, your entire profit is treated as money that you took home. All right. So you pay self-employment tax on your profit, and then you still pay income tax on your profit. I need you to keep that in mind, because sometimes you can have a profit when it comes to your book, doesn't mean you necessarily have cash in the bank. So how do you pay yourself if you're set up this way? You take what we call draws. All right. And I'm going to explain the difference of draws distributions later on. So a draw is money that you withdraw out of your bank account and you use it for personal stuff. You can set up the draw to go, to be regular, like every week, depending on how your money comes in for your business. You can set up your draw to be every 2 weeks. You can set up your draw to be every month. Now, this draw has no bearing per se on your taxes. So it's not money that you're going to be taxed additionally on. No. And this draw is not a business deduction to your business. It's just your money that you took out, most likely out of your profit. So whatever your profit is, let's say your profit is $80,000 and you took a draw of $40,000, you're still going to be taxed on $80,000. The draw was just you taking out cash. All right. So it has no bearing on your taxes per se. Does that make sense? So if you're a business owner, you're set up as a single member LLC. I know you guys always ask me, like, so how do I pay myself? You cannot put yourself on payroll. And the reason you cannot put yourself on payroll is because you and your business are not treated as separate entities. I said it to you, the IRS calls you disregarded. And disregarded means when I see you, I see your business. So there's no way you are hiring you and trying to pay you differently. No, because the business is you and you are the business. But if you wanted to change that, you can always make an election. And that election is where you tell the IRS, I want you to treat me and my business as separate people. That way my business can hire me as an employee. It's a business on its own. I own it, but I can work for it. All right. So that's where we're going to come to later on when we talk about S corps. But just remember this: when you're a single member LLC, you guys, you can take draws out of your business. The draws are not necessary, it's not taxable per se, because it's already considered part of your profit and you're going to pay tax on your profit. So whether you take a draw or you don't take a draw, you're going to pay tax on your profit if it's your bank account or whatever, wherever it is, if that makes sense. So I don't want someone to misquote me and think they'll take money out of their business and they'll not pay tax on it. No, your entire profit is going to be taxed. Just know that. All right. So you might as well take your draws out, but your draws are not a business deduction to your business. Okay. So that's the first group of people who are the sole proprietors and the single member LLCs. The second group now is the partnership. If you watched the video from last week, I explained what a partnership is. It's two people that came together, two or more people that came together for the purposes of making money, right? It's like a marriage, but the focus is money. Very clear, no confusion. Oh my God, I need to get serious. All right. So when it comes to a partnership, there are different ways that partners get paid. Actually, there are there are actually two main ways that partners get paid, but one of them, a partner can get paid through a guaranteed payment or through a distribution. All right. And the distribution generally is kind of like their share of profit or loss that goes to their personal taxes. So when it comes to, and then a partner can take a draw. And this is where I'm going to explain the difference between a draw, a distribution, and a guaranteed payment. All right. So in a partnership, you usually have, someone who is involved in making decisions for the partnership. Not all the time, but if you have a partnership where one of the partners is the one that is doing the work, the one that's waking up in the morning, going in, seeing clients, and then you have some other partners that do very limited work. Maybe they just invested their money and they're not doing as much. They can have an agreement that for the partner who is doing the work, that partner should get a fixed payment, almost like a salary, but it's not a salary. Okay, they should get like a fixed payment to compensate them for the work that they're doing. So like the example I used in my last segment, I talked about having, let's say you have a home health care, right? Or you have a service practice and you have a practitioner who is one of the partners. And she's the one who sees the patients and, that helps to bring in revenues. And then you have another partner that invested but is not as involved in seeing patients. The partnership can have an agreement for the practitioner to be receiving a guaranteed payment. That guaranteed payment is a business deduction to the partnership, but it's a business deduction before their profits are calculated, right? I mean, you deduct that you get to profit. Oh my God, how did I say that? Lily. Anyways, so the guaranteed payment is treated as a deduction. It's a business expense to that partnership because this person is one of the people doing the work that we're making money from. All right. Now, when we pay this guaranteed payment, we generally don't withhold taxes per se. That partner will pay self-employment taxes on that money on their personal taxes. Okay. And then in addition, now, when there's a profit, the profit is distributed to each partner based on their percentage of ownership on what we call a Schedule K1. That Schedule K1, now everybody will take their share to their personal taxes, and then they will report that income. And based on how involved they were, if they were active in the business, they would pay self-employment taxes on that as well, on that distribution. Now, if the other partner was a passive partner that just put money, had nothing to do, their income will be treated different because that's passive for them, right? They are not actively involved, so they are not paying self-employment income tax, self-employment tax on that distribution. All right. So with partnerships, you can have a partner get a guaranteed payment for the work that they are doing in the partnership, or they can get the distribution based on if the partnership is profitable and then their ownership percentage. All right. Now, there's one that you always hear people talk about, and it's the draw. Yes, partners can take a draw. And you remember how I've explained the draw when you're a single member LLC? It's very similar. The draw in itself is not necessarily a compensation per se. Neither is it a business deduction to the partnership. A draw usually would affect the basis of the partner that is withdrawing the draw. Okay, so if let's say myself and my friend Flora, we have a partnership. Okay, we both put in $100,000 in that partnership. Now, our business is going based on the basis of our partnership. Our ownership, our capital share, right, is worth 100,000 each. If I went into the partnership and I withdrew $20,000, guess what? My own capital drops to 80,000. All right. Now, it's not a business deduction. You remember how I explained that for the Schedule C? It's just me taking cash out of the partnership. Yes, it will affect my ownership percentage. Why? Because I have reduced the amount of cash that we have available for our operations, but it's not a business expense because it's not a compensation to me for work I did. I'm just taking cash out. Okay. Now, on my personal taxes, it's also not taxable, especially if it is less than my capital allocation or contribution. Okay. But if I took that draw and the draw is more than what my capital or my equity is, I would pay tax on the difference. All right, now I'm going to take it slow because there's someone who's going to watch this and they're going to be like, Dr. Lilly, I don't know what you just said over there. I'm going to take it slow. Okay. I'm trying to distinguish between a draw, a distribution, and a guaranteed payment. All right. I already explained that a guaranteed payment is what you would give to a partner that is actively involved in running a business. We got that, right? And then a distribution is what the partners would take home if the business was profitable based on their ownership percentages. And then depending on their involvement in depending on the kind of partner they are, the amount of tax they'll pay would vary. So if they were actively involved, they'll pay self-employment taxes on their profit, their share of profit. If not, then it's different. The person who takes a guaranteed payment is like a salary. That guaranteed payment, they will pay self-employment taxes on it. The partnership is able to deduct that guaranteed payment as a business deduction. Now, a draw, on the other hand, is different. A draw is just a partner taking money out of the business. Okay, so this is not necessarily a way that the partner is paying themselves. It's just them taking cash out of the business that they need cash because they need cash. And what that would usually do is that it would affect their capital account. So it would reduce it. If their capital account was worth 100,000, it's going to go down to 80,000. So this is not payroll. This is not a business deduction. It's not the same thing as profit. They just took cash out of the business. Now, if their ownership percentage was worth 25,000, for example, and they took out 40,000 in cash, 15,000 would be taxable. But if their ownership percentage was worth 25,000, but they took out 10,000 in cash, their ownership would drop down to 15. but they will not have to necessarily pay tax on the draw because they just took out the cash. It affected their ownership percentage, but because now the business doesn't have as much cash, but it's not a business deduction and it's not necessarily income to them. I hope that helps someone. All right, I hope it really helps. So that's how it works when it comes to partnerships. Okay, so now we're gonna go to S corporations. I hope that helps to simplify it. Then the next entity structure we talked about was S corporations. Okay, so when it comes to an S corporation, if you've ever followed me, you know it's one of the best business entity structures, tax structures, I'm sorry, that a business can elect for, but it's not for everyone. However, for those that elect to be treated as an S corp, they are generally telling the IRS that I, the owner, I want to be treated separate from my business. So even though I own the business, and if I was a single member LLC, you would call me disregarded. You report my business on my personal taxes and it will be disregarded. Now I want my business to be on this side, have a mind of its own. Okay, so the business can hire me even though I'm the owner, and when the business pays me, my pay becomes a deduction to the business, and then whatever is left, I will take. Whatever is left as profit, I will take as a distribution. So S corp shareholders or S corp owners, they take salaries and then they take a distribution. All right. Taking a reasonable salary is one of the requirements of making the election to be treated as an S corp, because the S corp is a tax election that you make to save on self-employment taxes. If you remember, I was saying for the single member LLC, if you have a profit of $80,000, even if you took a draw out of your business, you just took cash, you're going to pay self-employment taxes on $80,000, which is 15.3%, and you still have to pay your income tax, your federal and state income tax based on your income tax bracket. All right. Now, if you make the election to be treated as an S corp, what will happen now is, unlike before where you couldn't pay yourself a salary because you and your business are not separate, with the S corp can actually pay you a salary of $40,000. That $40,000 becomes a deduction to your business. Okay, and then whatever is left as profit, the other $40,000, you're only going to pay federal and state income tax. You're no longer going to pay self-employment taxes. So now you see, you would have been paying self-employment tax on the full 80. Now you only paid your payroll tax, which is the equivalent of that, on 40,000, and then the other 40, which is profit, you don't pay self-employment taxes. You only pay federal and state income taxes. All right. So that's the beauty of the S corporation. And so as a business owner, if you're an S corp, you want to make sure that you're running payroll. If you have any issues or you have questions, please reach out to us at the ARC. We'll be more than happy to provide guidance and explain to you how to set yourself up. Because if someone encouraged you to become an S corp but did not tell you that you needed to pay yourself a reasonable salary, they could get you in trouble. Because if you choose not to pay yourself a reasonable salary and you take all of your profit, that 80,000 as a distribution, now you just escape paying self-employment taxes completely on that 80,000. You know what Uncle Sam is going to do? They're going to reclass some of that 80,000 as part of your salary, and you're going to still pay payroll taxes, which both the owner and employee share comes up to the same 15.3%. But now you're going to pay a lot of penalties and fines on that. You don't want that. You want to avoid a situation like that. All right. Then our last entity structure now is the C corporation. Remember, the C corporation is a separate entity already, right? It's not like the S corporation where your profit will go to your personal taxes. No, the C corporation is a standalone on its own. When it makes its profit, it pays a fixed profit rate of 21% on its profit. If you were hired in your C corporation as an employee, you're going to get yourself a salary. If your C corporation did a distribution of dividends, you're going to pay taxes on that dividend. That's why they say C corporations have double taxation, because they pay tax on their profit, and when they distribute dividends to shareholders, the shareholders also have to pay taxes, which is the capital gains tax based on their income bracket. So it could be 0, it could be 15, it could be 20%, just based on what their income tax bracket is. All right. Now, however, as a business owner, if you made no profit in your C corporation, you paid yourself a salary, that's all that you're taking to your personal taxes. If you didn't have any dividends to take, then there's nothing. Now, do I encourage small business owners to set up as C corporations? Rarely. Okay, unless you're planning to seek funding from people that are not US citizens. If you're planning to go public someday, sell, depending on the kind of business, or maybe you want to enjoy some of the fringe benefits or things like medical benefits that come with a C corporation, especially if you have someone that might be sick in your family. But for the most part, it's not an ideal structure for a small business, because if you're paying double taxes, you're already going to pay, if you're going to pay tax on your profit and then pay tax to get a dividend, makes no sense. All right, so these are the different ways that, as a business owner, you can pay yourself. All right, remember, if you're a sole proprietor, a single member LLC, you can take an owner's draw. All right, if you're in a partnership, you can do a guaranteed payment if you're actively involved in working in the partnership. And you can also do, and then distribution. Everybody will take a distribution. So long if there's profit, all of us will get a distribution, because it's based on our percentage of ownership. But the actual guaranteed payment is for those that are involved in working in the partnership. Okay, so that way they are compensated for the time that they're putting into the business. Then when it comes now to an S corporation, you have to take a reasonable salary. And when I say reasonable, we're looking at industry standards. We're looking at the work that you're doing. If we had to hire someone else to do your work, what would we pay them? And then, of course, if we are profitable too. But we'll factor those things in. So as a business owner who has an S corp, you definitely have to take a reasonable salary. And then you would also get distributions, because whatever is left as your profit would flow to your personal taxes, and you would pay federal and state income taxes on it. All right. For unlike the partnership, you don't pay self-employment taxes, because you already that's the whole benefit of the S corp. But if you're in a partnership, you have to pay self-employment taxes on your distribution, and then also on the guaranteed payment. Distribution depending on the type of partner that you are. And then for the C corporation, if you happen to be an employee of your C corporation, you get your W-2 income as well, and then you will get dividends. So that's how you would pay yourself. All right. I hope that this helps you guys. I promised the team, I was like, I'm going to get this thing in before 3:45, and I think I'm right on it. If you have any questions, please do not hesitate. I want to point out a few things, guys. This payment thing has gotten a lot of people in trouble. If you are someone who is around like a payroll company and they're telling you, go ahead and set payroll up for yourself, please don't do it until you have made sure that your business entity structure allows for that. So if you're like a single member LLC or a sole proprietor, you cannot run payroll on yourself. Okay, as much as that sounds like it's a compliance thing, it's also on the money side, because when you run payroll on yourself, you pay yourself, the IRS will not treat it as a business deduction, because you and your business are not separate from each other. So that will still be counted as part of your profit, and you are supposed to pay all your full self-employment tax on that. So you want to make sure that if you choose to put yourself on payroll, that you actually go through and make the S corp election, so you can put yourself on payroll, have the taxes taken out, and it's the best way. Then the business is covering all of that, and it's a business deduction to your business as well. Okay, I hope this helps someone, you guys. As always, be reminded that I have complimentary 15 minutes sessions on my calendar, where if you have questions that pertain to you that you don't want to ask in public, you can always ask me privately. This is my gift to the business community. You're never going to see where you could, but there are not many CPAs that know what I know and are willing to share the way I love to share. And I really do. I feel incredibly blessed by God that I understand some of this, and I want to make sure that I leave it with you guys. And give it out all. So please ask me questions, empty my brain. I'm not going to take this with me anywhere, and challenge me, because when you guys ask me questions, especially things that I don't know, it forces me to also go back and study. When I was explaining something I forgot, it just occurred to me, see, that's what happens to me. I make all these notes, and then look, all of these, I didn't even flip anything, but I make these notes and then sometimes I forget to go through. But one thing I wanted to say, guys, is if you're a business owner, this year, the what do you call it? The threshold for the 1099 is changing. So before, if you paid someone up to over $600 and over, you have to issue them a 1099. Now that will be going up to $2,000. Okay, I'm just saying that for people that hire help during summer or just hire independent contractors, you're going to see that affecting most of the 1099s that you'll be filing. So just to keep that in mind. However, that is changing for the federal government. It might not change for all states. So you always want to make sure that you are in a, you want to check with your state to see if they are going to be changing that threshold to kind of match what the IRS has or not. That way you ensure that you're doing the right filings and you're doing it on time as well, which is usually January, before the 31st of January, once the year is over. All right. So guys, any questions, any comments? Thank you all who showed up to watch. You remember I told you guys, you know what my team did? They make me do this stream from what we call restream. So I'm not able to see social media because I used to get so distracted because I'll see people I know. I'm like, yeah. So now if I cannot see who is on, just know that I will see after. But thank you guys so much. If you're watching on LinkedIn, on Facebook, on YouTube, remember you're all my cousins, we're family members, because if we're going to be here spending this much time together, we're even closer than some of your family members, okay? So everyone on here, thank you, my cousins, for showing up. If there are any questions that you may not have asked me today and you watch this later on and it resonates with you and you're like, oh, I need clarity on this, feel free to shoot me a message. Feel free to reach out and schedule that free 15 minutes with me. And then grab my books too. I try to put as much in my books as well. So yes, grab a copy. This has been nice hanging out with you guys. Thank you all so much for being here, and I look forward to next week. Don't miss next week. I might make changes to the time, but I will still be on. This is running through summer. Come and get educated. Come and leverage my brain, what I know. And if there's something else you want me to cover, if there's a topic you want me to cover, please tell me. I've been asking that as well. If there's any topics that you guys want me to cover, I'll be happy to do so. Just tell me. I'll come and break it down, simplify it, so it can help you as you build or as you grow. All right. So take care. Keep enjoying your summer. And be safe out there. Be safe in the streets. It's hot. So please don't be dehydrated. Drink a lot of water. Bye, guys. And stay in touch.